Hello, everybody. On behalf of the entire Department of Accounting at the University of Miami Herbert School, I welcome all of you to the third and last event of the 2020 Business for UM series. For those that have not participated before, my name is Miguel Minuti Mesa, and I am the Accounting Department Chair and Associate Professor at the Business School. Before I introduce our moderator today, I'd like to deal with a few housekeeping items. The first one is thanking our moderators, panelists, Dan Medina, Kay Tatum, and other people that have made this event possible by giving their time and effort to put it together. And extremely important for anybody seeking CPE or CLE credits, please be aware that there will be 7 polling questions. They will appear throughout the session, will appear somewhat randomly. You have to answer at least 6 of the 7 questions to be eligible to get the credits. Once the session is concluded, you will receive an email with the replay of today's session. The replay or recording is not available for credits, and a survey that you must complete in order to finally receive your certificate. So please take care of that after the session. Finally, as you may be aware, this is an event that typically has a fee, and we use that money collected to help department initiatives. Any of those fees or the sum of those fees was used to fund things like extra assistance for some professors, for some students, PhD students, and other department initiatives like putting together this forum and putting together every other event. This year, due to COVID and following also the advice of our group of professionals that are in our advisory council, we decided to make this event widely available for free. So if you feel that you have gotten some knowledge or something interesting out of it, or perhaps you also want to help our department, you will receive later on an email with a link that says donate here. So please, we will welcome your generosity after today's event. Now, I'll move today to introduce the session. I feel that we have been lucky to get extremely good participants, extremely good discussion. But I myself have done some research on bankruptcy, and I find today's topic very timely and very interesting. And the professionals today will demonstrate that. I'm going to introduce our moderator, Maria Yip. She is the founder and managing partner of Yip Associates, a firm that specializes in forensic accounting, financial investigations, receiverships, and other fiduciary roles, bankruptcy-related matters, and valuation. Her firm serves its clients all over the place: Miami, Fort Lauderdale, Tampa, Orlando, the Northeast of the United States. She has previously worked for Price Waterhouse, Arthur Andersen, and led most recently the forensic practice for Florida Grant Thornton prior to starting her own firm. She is a Florida certified public accountant, a certified fraud examiner, certified insolvency and restructuring advisor, and she's certified in financial forensics. So she's plenty of relevant credentials. She's a sitting United States bankruptcy panel trustee in the Southern District of Florida. She also serves as a court-appointed receiver, examiner, liquidating trustee, custodian, assignee for the benefit of creditors. She has over 25 years of experience serving as a forensic accountant and expert witness. Clients in all of the legal system, and regular serves as expert witness in federal and state court, international litigation, arbitration, and her firm, Yip Associates, has been a supporter of the Department of Accounting and hired a number of our students in the prior years. So it's it's with great pleasure that we have her here as our moderator, and she will take care of introducing our other panelists. So thank you very much. Welcome, and I'll give the word to Maria.
Thank you, Miguel, and good morning to everyone. So the only takeaway I think from that very long introduction is that I'm certifiable, and I will walk us through, hopefully this morning. We hope to give you a wide spectrum of discussion, walking us through everything from the current state of the business community and businesses at this point in time, through the challenges that they're having, and then what some potential resolutions might be, or some considerations for them. With that, I'd like to walk you through the background on the panelists that you're going to hear from, which will walk you through that process. First, Coralie Lopez Castro is a bankruptcy attorney, a partner with Kozak Tropin, who I've known for many years, and known by those of us who've known her as Corey. So you'll see her referred to that way today. Corey's practice has been concentrated in the areas of bankruptcy and commercial litigation for many years. She has extensive experience with bankruptcy reorganizations, liquidations, receiverships, debt restructuring, and creditor rights. She's been involved with the liquidation of significant bank holdings and in bankruptcy courts around the country, as well as in the state. Corey, similar to myself, has served on the panel of bankruptcy trustees for the Southern District of Florida, and she did that during the years 1998 through 2002. And in that role was responsible for the liquidation of numerous assets in the bankruptcy cases. Corey has been with Kozak Tropin since 1998, so I consider her kind of a lifer, very loyal and dedicated, just outstanding professional in our community. She's very much a role model for many of us. Corey served as the firm's managing partner for several years, and she has been inducted as a fellow in the American College of Bankruptcy, which is very prestigious. She is also known to many of us in our local community as the second woman president for the Cuban American Bar Association, which is one of the largest associations in the state of Florida. So we're very lucky to have Corey available to serve on this panel, and she's got some fantastic information to share with the group. Corey, thank you. Next, I'd like to introduce Brian Engstad. Brian is a senior manager at one of my former firms, Grant Thornton, in the group of mergers and acquisitions tax services. He is joining us from Atlanta, Georgia this morning. Prior to joining the Atlanta office, Brian worked in Grant Thornton's Washington National Tax Office for 2 years, which is very significant training and experience that professionals coming out of the national office have. For over 14 years, he supported and advised companies throughout the business cycles on incorporating acquisitions, mergers and reorganizations, leverage buyouts, recapitalization, liquidations, divestitures, and corporate distributions, and certainly bankruptcy. And he's going to be talking quite a bit about the impact on businesses as they consider some different options, and with his experience working in various industries, and also understanding what has to be considered when you're trying to work something out, do a debt workout in a Chapter 11 case. So we'll be hearing quite a bit regarding considerations that businesses need to take into account as they look at the some of these different options that Corey is going to propose. And Brian, thank you for joining us. Last but not least, Sergio De La Fe. Sergio is a partner with RSM. For those of us that are, I guess, have been around for a long time, I still think of it as, you know, RSM McGlattery. Sergio is currently serving as the firm's National Enterprise Accounts Leader and National Industry Leader for the industrials industry. During his tenure at RSM, Sergio's been responsible for the ultimate oversight and governance of RSM U.S. firm, which is no small feat. Sergio has served a number of Fortune 500 and middle market companies globally in a variety of sectors, including industrials, consumer products, and financial services. He's also the national founder of HOLA, a RSM employee network group that provides leadership and advancement support to RSM's Hispanic and Latino professionals. My experience with Sergio goes back to our days working together with Alpha many, many years ago, and that's the Association of Latino Professionals for America. Sergio holds a Bachelor's of Accounting degree from Florida International University. I don't want to hear any boos from the alum, as well as a graduate certificate from the Wharton School of Business. And Sergio, thank you very much for joining us this morning. So Sergio, if you'll start, just, we have a polling question. And that's the last time that I'll let you know when that comes up. So people have to pay attention if they want their credit. So Sergio, if you'll talk to us a little bit about the current situations for companies as far as what you're seeing with your clients. And it's certainly something that none of us could have ever imagined. So with that, why don't you walk us through companies that are actually still healthy.
Thank you, Maria, and thank you for that introduction. And hello, everybody, and welcome this morning, and good morning. Good morning. I also want to take just a quick moment to thank Daniel Medina, Professor Miguel, Professor Tatum, and Christy Gonzalez for the help, putting this together. Stefani, also, thank you so much for just setting this all up for us and making it very smooth. So, business continuity in the year 2020, has just been unbelievably different. What can I say? If I would have told you in January of 2020, when we had, one of the hottest economies, the lowest unemployment rates, and just booming earnings by companies, and just a phenomenal setting that the world would change in less than 45 days completely, globally, you'd think I was crazy. And that's just exactly what happened. Business continuity before this winter was about evaluating your processes, your businesses, your resiliency in IT, certain business processes, and evaluating a business impact analysis and what would happen if something went wrong. And that's what business continuity was, in January. For many years, I've worked with our clients and friends to think about, what are those risks, what are the issues that they face, and how would they respond, right, in the case that some of those issues or risks would materialize. And, what would they do for continuity? How would they deal with it. In South Florida, you know, we deal with hurricanes and natural disasters and those kinds of things. In other parts of the country and around the world, we have, you know, many different risks. Pandemics are a risk. And, you know, I performed a risk assessment for one of our clients here in South Florida. We considered a pandemic. We considered a pandemic very critically. It was in our top 20 risks, but we never imagined that it would be a global pandemic that would shut down businesses virtually pretty much around the world. And so it was one of our top 10 risks, but I don't know if we really evaluated it or analyzed it or considered the impact of a global pandemic that really shut down most global economies. So the dynamics in the winter changed, right? Survival and uncertainty were, and they continue to be pretty paramount. Many of our clients are still in a survival mode, and there is a significant amount of uncertainty. Today I read in the Wall Street Journal, if you all do that in the mornings, you probably saw, you know, Spain and France and the UK are considering you know, further lockdowns, localized lockdowns, which will hurt supply chains and will hurt different types of businesses. This is continues to be a very uncertain time. There were a few things that we noticed that became, you know, critical. Liquidity, you know, your workforce dynamics changed, right? Think about in February, we had the largest employment population ever in the history of the US and pretty much the world. And in late March, employees couldn't come to work and travel was halted. So things just shut down. Just a dramatic change. You know, supply chains were completely upended. You know, many demand for certain businesses just disappeared completely. You could think about cruise lines or airlines, among others, where things just stopped, right? It's something that's completely unprecedented. And then supplies were, you know, unreliable. China shut down before we did. Things that came from China, parts, products, and things that were critical to some US businesses, they could not obtain. It couldn't reach them. That was just a complete disruption in their businesses. And that was before pandemic issues hit here in the US or challenges happened in the US. So even at the beginning in January and February, we saw some impacts on supply chains. And then there was significant legislation and regulation that was coming along from Washington and different state local governments. And you wouldn't think that would be a big deal, but in certain states you had to close. In certain states you didn't have to close. Certain states opened earlier, other ones opened later. And if you had a business that had operations in multiple states, you had different regulations and rules you had to follow. I was on a presentation yesterday with Senator Klobuchar from Minnesota, and she was talking about why we don't have, asking why we don't have national standards for testing so that people can go back to work, right? Or we can have a national standard on different things. That still doesn't exist. It's still pretty much regulated county to county, state by state, and in different areas, causing, you know, significant challenges for clients and businesses to reopen or to make sure that they operate, you know, confidently. So these things really became important. We came up with 5 different things. Maria, if you could switch to the next slide. We came up with 5 different areas that were we focused on, and we saw our clients working on, and for their business continuity, this was what they were focused on. These were the areas they were focused on. First of all, they had a lot of risk and uncertainty, right? The traditional business impact analysis, as we normally did in a business continuity effort, was no longer viable. There were too many uncertainties. You could assume certain things would happen, but the impact that you came up with could be completely very different. And how to respond was an unknown, because pretty much all different things were not reliable. You know, continuity was not just focused on one process or a function, but on just the complete viability and survival of a company. It was completely an enterprise effort, not just a particular process and so forth. Many times when we do business impact analysis, we're worried about, you know, well, how can we back up and you know, our IT function so we can have records and still operate, you know, our business as usual. One location goes down, so can that location be backed up? In this case, that wasn't the problem. The problem was nobody could actually come to work and nobody can come to your business. So it was really a dramatic change from what we had seen in other instances or other analyses. Liquidity became paramount. Cash flow sources were completely unreliable. Revenues for some businesses dried up overnight. And therefore, not many companies were created or have the funds and the liquidity to operate without ongoing continuous revenue. They may have reserves and capital to withstand certain impact and reduction of revenue, but it's really hard to operate at 25, 30, 50% of revenues. And that's what happened. So how do you preserve cash flow? How do you look at your fixed costs or your variable costs so you can adjust? And then traditional financing sources completely changed. Banks were hesitant to lend early on, unless they were some of the government programs, because they didn't know and had very little reliability on trends and valuations and forecasts that companies could put together. So the financing challenges were interesting also. So many of the recommendations that we made to our clients and the issues that we faced were in this area of liquidity. Is how do, and we'll, Brian and Corey will talk a little bit more around the bankruptcy issues and the tax consequences and other opportunities. But as you can imagine, companies did not have, the cash in order to pay all of their fixed costs, much less their variable costs. So this became a significant effort for companies to forecast cash flows and do a reforecasting of all of their costs associated with their businesses. So a very, very intense effort that we found. As the pandemic continued to rage, and it continues to be a significant issue, is the workforce. Employee safety is paramount. It's something that we did not take, well, I wouldn't say we didn't take it seriously, but it wasn't the primary issue with our workforce was not necessarily safety in many businesses. Safety was considered in areas where there may be hazardous conditions or the like, but we never worried about employee safety in an office. It was not the primary concern, but today it is, right? If you have a retail environment, if you have a office environment, if you have a plant environment where you're manufacturing things, employee safety is not just safety with machines or hazardous areas, but safety from each other. So that has been, paramount for our clients. And then the other element is the remote workforce and employee engagement. So how you engage with your employees and your employee networks has completely changed. A lot of us are used to doing this. I have a complete television studio here at home because I'm always on video. And this has been the new normal for many. Many of our clients and many of the companies did not have the infrastructure from technology perspective to move to a completely virtual world or to a completely virtual and remote workforce. Many of the tasks were intended to be done in person, and this changed significantly. And this caused a significant disruption for our clients and for their employees because they did not necessarily sometimes have the skills to work in a remote environment or the tools to work in a remote environment. And this caused significant change. Zoom has obviously benefited from that. They are top of the news and top of the heap right now, as you can tell. We're using a Zoom platform here. And that's some of the changes that I think will not go away from this area. And again, liquidity, workforce, and this risk and uncertainty continue to be challenges for our clients today. This is not something that has gone away. It is continuous. Have we learned to live with it and manage it better and implement different processes and safeguards towards it? Absolutely, but it still remains a challenge for our clients. I mentioned briefly a few minutes ago around supply and demand shock. Businesses earlier in this year experienced the most extreme demand shocks potentially in an entire century, probably ever. And when I talk about demand shocks, I refer to the demand that businesses had for their products and services. I'll use some very obvious examples of airlines and cruise lines. The demand for their products just really dropped off the table, going to almost zero. Many of you here in the participants may work for some cruise lines, may work for some of the airlines here in town, and you obviously seen the dramatic changes, but some had significant demand increases. So if you think about, supermarkets and Clorox wipes and all of these different things that had demand spikes because of the demand for products, the demands in personal protective equipment, went through the roof, and those companies also experienced significant shocks because they had now this extreme demand that was very high, but their supply chains were locked up. They couldn't get materials. They couldn't get their workforce to work with them. This also caused a problem because despite them having a significant demand for their product or their services, they couldn't provide them. And that hurt the public, it hurt public safety, but it also hurt their ability to produce and create, capital for their businesses to survive. So despite having positive or negative demand shocks, that companies were struggling to really meet the demand or to even have any demand. And I mentioned briefly that supply chains were locked up. Early on in the pandemic, when other countries in Asia and Europe closed down and shut down before the US did, you would see supply chains not being effective in getting products and goods and parts and components to the plants and to businesses here in the US. Therefore, they couldn't deliver on their products and services. So you see long lead times in terms of delivery, long lead times in terms of products being completed or product and manufacturing processes being effective. So again, a hugely significant impact on supply and demand, which was something that in business continuity and in business impact analyses was always something that would be a little bit more stable. We'd say, okay, the supply chain could be interrupted, so we would diversify supply chains. We would have multiple plants, multiple production areas where you could diversify. But when the entire world shut down, it would be very difficult to fathom in prior business continuity impact analyses that you would not be able to obtain a supply from anyone around the world. Some of our clients have plants in Asia, Southeast Asia, Europe, and they always felt that they can diversify because, okay, well, if Southeast Asia shut down, we can get stuff from Europe. Well, they were both shut down. And so now that has been a significant challenge. Many of our clients are especially in the industry that I serve in industrials and manufacturing, are really thinking about nearshoring a lot more of their supply chain, so that way that they have things much closer. It may increase some costs, but the proximity may be an important element going forward. So the issues that have been caused by the pandemic and the changes and the challenges that our companies have faced, I believe will really have an impact in how supply chains and businesses consider the proximity of production units and production capacity in the future. And then finally, there was so much legislation, and I know Cody and Brian will talk about this a little bit later on, but I'll just mention it as a core component and pillar of what companies were facing was, the different policy and legislation that was coming out. Governments globally were enacting new policy legislation in response to domestic issues. So it was no longer a global environment where countries and locations were thinking about the impact of their legislation more globally, but they were really focused on domestic responses, whether they were stimulus packages or tax breaks, very focused on domestic impacts. For example, some of the legislation passed here in the US, the funds on some of the acts, the CARES Act and others, maybe were not available to international subsidiaries, which was an interesting component, right? So you had really important businesses here in the US that were operating, but they didn't have access to some of the stimulus dollars, for example, in some cases. So interesting dynamics that happened as as legislation came out. In addition, the regulations around opening back up, coming back to work, limitations, curfews, lockdowns, different jurisdictions, different rules. As we know here in Miami-Dade County, we were a little slower to open up to the rest of Florida and other locations, and that causes different impacts for our businesses and for our workers. So can we go to the next slide? Thank you so much. So we thought about how some of these areas, and these slides I believe will be shared with all of you a little bit later. We put together some challenges and some opportunities, right, for each of these columns and areas. And as you can see on here, and I'll start with just giving you some examples, because I'm not going to read all of these things, obviously. In liquidity, do I have enough cash for the foreseeable future? What costs can I cut without hindering our ability to ramp up and scale back quickly when the market normalizes? When is normalization? How much cash do I need to have on hand? And this really, after a while, some of our clients noticed it was an opportunity to reconsider their entire cost structure, right? And the investments that they wanted to make. And Brian will talk in a few minutes about, strategic acquisitions in this time and investing in distressed conditions. But it was an opportunity for some of our clients that did have liquidity and did have capital or capital backing to potentially make acquisitions in particular areas that would enhance their cost structures and enhance their business positions, which was an interesting issue to have in a distressed environment. But whenever there is a challenge, there's always an opportunity for someone, and I know Brian will talk about that in a few minutes. The workforce conditions was also something that we continue to see decreased. We need to focus, and companies were trying to focus on how do they decrease absenteeism and people getting sick, right? It was very important for plants and core essential businesses to make sure that they reduced the illnesses and absenteeism. This was very, very important. But the changes that many of our clients have made are long-term positive changes where, they have done things in terms of spacing out their production floors. They've spaced out certain areas. Right now, if you go to the supermarket, there's a big plexiglass screen across from you and the cashier, right? Will that be permanent? We don't know. But in other settings, that might be very positive for the future of different businesses. The supply chain and demand shock, this is where I think our businesses have seen, the biggest opportunity for enhancements. Many of our clients and businesses had become very complacent with their existing supply chains and the cost structures that they have, and really had never had to challenge the different flows of goods and content that they had. And this was really an opportunity to rethink the entire thing. So many of our clients have started to rethink their plant structure, their supply chains, their flow of products and goods into the US, into their markets, and how they do distribution to their clients. But then they've also had to rethink their product mix. They had to rethink the products and goods that they provide to their clients and the services that they provide. And this has really helped some of our clients rethink and to diversify their revenue streams and diversify their cost structure and find new suppliers and new customers. So this has been, a very difficult time, but also a time where many companies have had the opportunity to rethink and reconsider some of their challenges and look at a reduced cost operating model. Many of our clients have found that they have been able to reduce costs and still operate, and that is something that's going to permeate into the future. These cost savings are now maybe permanent in some ways, where companies have realized, well, we don't need to spend that to do this. And that has been a significant investment. For us in our business, it has become apparent that we don't need as many internal meetings as we used to have. We can do them on Zoom, we can do them on video and save enormous costs for example, and that's just in our business. But other businesses are facing and finding similar cost savings. So we've also, Maria, if you want to go to the next slide so I can start wrapping up. And we do have the Q&A down below. If you have any questions, you could type them in and we'll answer them as we go through. I might answer them live or, or type an answer in the short term here. I've also laid out, by executive, some of the things and areas that our executives were thinking and that they could be and still are thinking about. We have some questions that the CEOs, CFOs, and COOs may be thinking. We also have a CIO and HR and some owners on the next slide. But these will be here, and you can take these away so that you can work within your companies to ask these questions. And the first one on the CFO is now the right time to make a strategic acquisition? I know Brian will talk about that and how to go about doing that and what you should consider. But it is an opportunity. There are distressed businesses that may need capital. And if you have capital, then it may be a good opportunity for you to acquire something you didn't have before. And you may be able to get it at a favorable price or a mutually beneficial price because some people are distressed. And that may be an opportunity. How do you maintain liquidity? Maintaining liquidity is paramount because we don't know what's going to happen in the future. There's a question that I received from Rick at RML Capital about the risk of the U.S. election and if the results are challenged. But I will say this, is that there are very different perspectives by the different potential administrations in terms of shutdowns and how things may happen. The current administration has been very focused on reopening. And you can argue too early, too late, doesn't matter. But they've been focused on reopening. Some of the comments made by the potentially incoming administration around further shutdowns if necessary, et cetera. And without getting political, it does have an impact, and there are differences in how the different administrations would handle certain situations. And that does have an impact on how businesses and liquidity would operate. If there is a shutdown, cash liquidity is paramount. You have to have that liquidity in order to operate or to stay open and to survive. Also, in the CFO question, should I reevaluate my suppliers and vendors? And that's something that we've seen clients do to reconsider whether it's proximity, whether it's price, whether it's reliability, whether it's quality in this new world. All of those things are elements that should be considered. So with that, Maria, if you just want to show the last slide there, that different executives may want to consider. We know we have a number of different executives online today, and I wanted to provide a few things of consideration for the different folks that may be online and participating. So with that, I will, turn it back to Maria. And I got a question. Patrick Farrell asked a question, how do I get the deck? I believe the deck will be shared later with everyone. Is that right, Maria? Maybe you could share that. So thank you so much. Again, if you ask any questions on the Q&A, I'm happy to answer throughout the session.
Thank you, Sergio. And we are now moving into the next segment of our presentation, which is dealing with these liquidity issues and considerations that are really part of what we've been calling the M&A movement at this point in time. So, Brian, with that.
Yeah, perfect. Thank you, Maria. Sitting on the service side, even before COVID, I spent a lot of my time trying to identify, when a company may become distressed. And, I think of it much like your doctor looks at different symptoms to diagnose you. We're looking at different signs that, show the health of a company. Sergio, mentioned obviously right now, the economic environment overall is causing a lot of companies that were otherwise very healthy earlier in their year to become distressed. I think, right now, we'll touch on a little bit later on, the stimulus package and even the banks have been extremely friendly. So we've seen a wave of bankruptcies and large, debt workouts. I think, later in the year, maybe in 2021, we may see even more. So a second wave of workouts. Another sign is just industry disruptions. This year, I think the energy sector got hit twice, right? They got hit with COVID, and then energy prices fell, which caused a lot of energy companies to have to do, file for bankruptcy or do these large debt workouts. There's been obviously other industry disruptions. You think about in the retail sector, that just the changing consumer taste, right? That people don't want to necessarily go to your typical brick and mortar. And we've seen a large segment of retail companies filing for bankruptcy. Sergio mentioned as well that the supply chain disruption for manufacturers has been a real issue as well. Another sign is, a debt maturity coming up and the ability not to pay. Obviously, this is a huge issue and is frankly fairly late in the game to be identifying. But certainly, if they can't pay their debts, that's a real issue here. Missed debt covenants, that's another one. Or needing to renegotiate debt covenants constantly can be a sign that the company is headed for some form of distress. Deteriorating sales or margins and increasing expenses. This is obviously a sign that the business may not be operating as efficiently and that they're starting to lose value and maybe pushing for distress. History of asset write-downs, in the financial statements, you may see things like goodwill impairments or other write-downs. This is a sign that the value of the business is dropping. And as the value of the business drops, their ability to continue to generate cash to pay the debt starts becoming hampered. History of late payments to vendors. This is a sign that potentially that they have liquidity issues, right? So they start paying their bills later and later. It could be that they have a tightening on liquidity, and especially if a debt's coming due soon, this can be a real sign that they may not be able to make that payment. Failure of a plan or significant damage to assets. Obviously, if you're a manufacturer and you have a significant damage to your plant, it's going to affect your ability to continue to do business. So that can be extremely huge. Material litigation. That's another huge one. We've seen companies like in the tech industry that run into litigations with like their IP, for instance. That's sort of their bread and butter. And if someone's attacking that, it may force their hand to have to file for bankruptcy or do something major at least. Resignations of senior executives and or folks on the board. This can be a sign that there is something underneath the surface that's slowly starting to bubble up. So it's something to look for. And then there's, I wanted to point out, there's a lot of models out there that are put in place to try to identify if a company can be distressed. A lot of these models are weighing different ratios. Historically, you'll find that there's a lot of models that have been very focused on public companies. The reason for that is the information's public, so it's been extremely easy to gather up and compare. I think we're seeing, though, slowly that the models are becoming more and more focused on private companies as well. And these are great indicators that, just based upon the ratios that, hey, a company may become distressed in a year or two. So it's really looking at those operational inefficiencies within the company to spotlight. Maria, if you want to go to the next slide. So as Sergio discussed, it actually is a pretty good time that if you have the capital to potentially do distressed investing. I mean, there's a number of factors to determine whether this is the perfect time to do distressed investing. Obviously, some of it is your view on how quickly the economy is going to bounce back and how much liquidity that you have and can sit on before you have to start generating the cash from the business you're going to invest in. But obviously, if you do have a long window that you can wait, right now may be a great time to acquire companies at potentially an extremely low value. Historically, we've seen distressed investors come in, three flavors. The first one would be the strategic buyer. So this is a company that may not have previously had any investment in the distressed company that they're looking to invest in. You think of, for instance, like a car wash business, right? They see a company, another car wash filing for bankruptcy and decide to, invest in them to do roll-ups. It also could be somebody like looking to do some vertical integration, right? So maybe a supplier is filing for bankruptcy, and even though the buyer didn't previously invest in the supplier, they may want to do that strategically to position themselves going forward. The second historic distressed investor that we see is original lenders. This could be banks, PE firms, other folks that lend money to businesses. Often they become distressed investors, not necessarily by design, but because the company that they've lent money to finds themselves in a distressed position. Typically, the way an original lender will invest in the company is by doing a credit bid. So they'll credit bid in their existing debt in order to take over that company. And then the third distressed investor that we see are folks that were not necessarily the original lender, but are the current holder of debt. So the way they'll get in this position is the debt may be trading at a very low cost right now. And there's a lot of investors that will go buy up that debt at the low cost in the hopes that, that investment will turn around. So they'll typically take over the company, the same way that the original lenders do, and that they'll credit bid their debt. I will say that this is obviously maybe one of the more risky areas, but it does have a huge upside. And even if they're not able to take over the company, so there may be a higher bid or the assets are worth more, they still may win out, right? Even in a liquidation, because they bought the debt at such a cheap price. So there is a huge upside, and we certainly see a lot of folks pursuing this path of distressed investing. So one of the keys to distressed investing is, how do you evaluate a distressed company? Typically when you think of your sort of typical investment path, you'll look at the 12-month trailing numbers, you'll look at EBITDA, you have all this financial diligence information. Well, that information, although is useful in distressed investing, it's not necessarily 100% reliable, right? The company has become distressed, so there's something within their operations or that obviously may not be working. So you don't want to rely on the typical, numbers 100%. So really what you're trying to look at and trying to understand and get underneath is, what do you need to make the business work? What's the budget going forward? Typically, you're going to know the value of the assets. So really what it comes down to is understanding those liabilities that you're going to be taking on from the distressed company, and two, those liabilities that you may need to incur going forward. I know Corey will touch more on liabilities in a bankruptcy setting, but one, obviously within bankruptcy, if this is the path that you're doing distressed investing, there are certain liabilities that you might be able to shed. What becomes important in distressed investing, though, is even though you might be able to shed some of those liabilities in the bankruptcy, you actually may have to take them on because they could affect the value of the assets that you're acquiring. So, you think of things like gift card liabilities, right? Maybe you could shed those in the bankruptcy path, but they could significantly impact the goodwill of a business going forward. So those are liabilities you might need to take on. So it's extremely important to get your arms around not only the value of the assets, but the liabilities going forward, and coming up with a budget. So moving on to the next point here around stalking horse bidder. This is a mechanism that some distressed investors may use. So stalking horse bidder is typically something that you'll find in a bankruptcy. And the purpose of the stalking horse bidder is that the bondholders in a bankruptcy become extremely nervous that they may not get a fair price for the company. So what they have done historically is they'll get a pool of bidders, and they'll pick one bidder, the stalking horse bidder, to come up with a price to acquire the distressed company. And effectively what they're pushing for is that price becomes more fair than maybe if they just went through the typical path. There are some advantages from being that stalking horse bidder. One advantage is that you get an extended diligence period. This can become extremely important in if you're acquiring a company out of bankruptcy, because for the most part, you're kind of acquiring the company as is. So it's extremely important to understand what's going on in that company. You also get some expense reimbursement. That can be very helpful as well, because you're going to incur, potentially a lot of fees and time and expenses in evaluating a distressed company. And then if for whatever reason, somebody comes over the top and bids higher than you after the stalking horse bid was put in place, you might get some breakup fees. Typically, this can be between 1 to 3% of the purchase price. So there's really significant advantages. There are obviously some disadvantages to being the stalking horse bidder. One is, like I said, with the extended diligence period, you're likely going to incur a lot more time and rack up some fees, and maybe you don't get all those expenses 100% reimbursed. The other one is, and there's been some thought about this before, is when you give that bid, the intention was always that the bid would be the floor, but really does that bid also become the ceiling in a way? So, you bid $100, and then after that bid is put in place, nobody else bids anything else. Well, maybe you could have bid $90 rather than $100. So there's always kind of this fear, right, that potentially you may have paid too much or more than you needed to. So Maria, I will turn it back over to you for the Q&A.
Thank you, Brian, and Sergio for the first two segments of our presentation. And so at this point, we'd like to see if we could, if there are questions from the audience.
I have a question for Brian. It's Corey.
Yes.
Is it okay? Is it okay if I jump in, Maria?
Absolutely.
So Brian, before the pandemic, we saw, or we observed, there was a lot of money out there that was looking for deals desperately. The interest rates were low. There was both smart money and stupid money, I think. What I've seen since the pandemic, there's still a lot of money out there, but I think the investors are being more cautious as to what deals they're jumping into. You jump into a distressed situation and you get a good deal, it's because the company is in distress and you may not understand the business. Do you see the same thing, that the money out there is being a little bit more cautious before they go in and invest in a distressed company?
I do. I have certainly seen that and had the same experience with you. Obviously, before COVID, there was a ton of money out there, good and as you said, dumb as well. And I think the prices were starting to skyrocket in a way that, frankly, I hadn't seen before. They were getting extremely high, and especially in some of the more speculative areas. You think of things like technology, the prices were just astronomical. I agree that since then that we're seeing folks probably become more strategic on where they're employing their capital, and where it makes more sense. Certainly, I think maybe the one slight caveat is those folks that are looking at acquiring the debt on the cheap and then potentially turning it around. I think there's a lot of folks tapping into that may not have before. You know, debt right now, just I think across the board is publicly traded debt is trading at, you know, significantly low costs. It's just, and we'll talk later on how that's potentially a terrible tax answer sometimes, but that's where I've seen folks may become a little more risky, right? If you can acquire debt at 30% of face, I mean, that can be a good gamble. That could be extremely good gamble. So that's where I've seen people maybe go outside of what they've typically invested in.
Thank you, Brian.
And Corey, to the question you were at, that you posed, one of the things that I've seen in bankruptcy cases is that there was international money coming in. And so I think that's also an issue that we're living in a different time. And the impact that Sergio was talking about earlier in the various the countries across the world, at least in some of my cases, those are that was the origin of the monies to make the acquisitions, to be the stalking horse bidder, and things like that. So I think that the impact that we're seeing around the globe is going to, you know, not only impact the stalking horse bidders, but impact just all of the potential buyers that are out there, especially in the community that we live. We see so much of that in South Florida. Dan, are you on? Dan Medina?
Yes, I'm here.
Okay. Do we have any other questions from the participants?
No, you guys addressed all the questions at this time. So you guys want to do that 5-minute break?
I do have one question I can see here. Hi, Brian. How have you mitigated the fear of overbidding in the past? Are there objective measures, ratios that you use when you're helping your clients in the distress acquisition? And what point does it become an emotional decision? And I've sat in enough of the biddings and different properties that I've had as a trustee, and I do get to see around the conference room when we all used to meet in conference rooms, how emotional it gets as far as the acquisitions and people not wanting to be the loser, so to speak, that day. So I think that's a great question, and perhaps you can have other comments on that.
Yeah, you know, I think it depends. One, it certainly depends what sort of distressed investor you are, and what you potentially have to lose, right? So if you're the original lender, you know, I think the way you're going to view and evaluate the company may be significantly different than if you're someone that went and got the debt for cheap. If you got the debt for cheap, to an extent, it's sort of interesting, right? In the credit bid process, it can become a little bit of, I hate to say it, but funny money, right? So if you acquired the debt, like I said, at 30%, you can credit bid 100%, you can credit bid, you know, 90%. It doesn't really sort of change your overall investment. So I think that gives you a lot better leverage, and some of the importance of the ratios, frankly, probably change quite a bit. Whereas if you're the original lender, I think it becomes, you know, a lot more of a strategic question around that. At what point does it become an emotional decision? I agree with you, Maria, that at the end of the day, it can always often boil down to an emotional decision here. I think, you know, a lot plays into it, depending on where you originally came into play with the distressed investor. You know, if you're a PE, right, that maybe had loaned money, I think you're going to have a much, originally loan money, you're going to have a much different emotional attachment to the company and holding on to the company. Whereas if you just, once again, got the debt for cheap, you may not have any emotional attachment whatsoever. You're just trying to look to turn a profit that you can show to your investors and kind of move on. I think that's where I see a lot more of the teeth grinding, I think, is at the end of the day, the distressed investor, a lot of the times can be a bank or PE, and they have somebody to report these numbers to, right? So at the end of the day, I think it becomes that is their push point. Do they need to show a profit? How quickly do they need to show that profit to their investors? And I think that can quickly, change your view and your answer in each individual situation.
Corey, I know that you've got the next segment and we're running just a few minutes late. So I'm just wondering, is it okay to skip the break and just proceed with your segment?
Sure. So before I jump into the next segment, I did want to say a little bit about the last question, which I thought it was an excellent question. It's always emotional, and Maria probably has presided over how many auctions. And one thing that I can tell you is those who are losing their business, that's really emotional. I mean, they're looking to see who may hire them once they buy the business. Sometimes a buyer will offer, to employ a certain amount of people. So I think it's always emotional, and those are very hard things to watch when someone is losing their business. So, and by the way, when you have two guys in the room and they want to show who has more money, I do think that the bidding gets out of control. But that's always good for Maria when she's trying to sell an asset. So she likes, to a certain extent, she likes it to get emotional, so she can recover more money. Anyway, so let me tell you a little bit about myself. I started practicing law in 1990. So that means that I've been through a few cycles. In 1990, there was a real estate downturn. There were some huge bankruptcies here in Southern District of Florida. Then we had the 2008, which was a huge crash. And that was really a very, very busy time for bankruptcy professionals. So what happens next is we have this. In February of 2020, I attended a program of the American College of Bankruptcy, and there was an economist, and the subject matter was, does growth have an expiration date? Because there had been so many months of growth, and people were looking to see, okay, what does the data show? Are we looking at another downturn? The metrics did not show a downturn or indicate a downturn. The only data point that showed that there may be a downturn was there was a slowdown in car sales. That was it. Not housing, not employment, and not interest rates. So it looked like we were all good, and then the pandemic hit us. We've seen some large bankruptcies. Brian mentioned retail. Retail has been in a tailspin, I would say, for a few years now. Customers wanted fast fashion, but the supply chains were not set up for that. You had brick and mortar stores were just dying because there was not enough traffic in the malls. And then you can imagine with the pandemic, this just put everyone over the edge. You had JCPenney, you had Neiman Marcus, they were already dying. So this just literally required them to file Chapter 11. But, this was something that was happening in the retail sector. This cycle is different because if you cut off someone's top line revenue, how do you recover from that? Okay, one thing is if you have some operational deficiencies and maybe you have a few too many employees, or you literally needed to get rid of some product lines, you can manage that. But when your top line revenue is shut off, that is a very, very difficult issue to address. And that's why this will be more challenging than any other cycle. I think that Congress actually did something, and that's one of the questions that we saw on the chat, did something and was ahead of the game. I don't think I've ever seen that. I mean, if someone has, I'd like to know, but Congress was ahead of the game. Historically, small businesses have struggled in Chapter 11. In fact, many of you in the audience probably know that there have been a fair amount of bankruptcies, but not many reorganizations. You had asset sales. The only reason to go into a bankruptcy was to sell the assets of a corporation, not the traditional reorganization, because it is very expensive to go through a Chapter 11. And you have to go through a Chapter 11 quickly because cases don't age like fine wine. The more time they're in bankruptcy, the more difficult it is for them to actually emerge from bankruptcy. So Congress last year passed the Small Business Reorganization Act of 2019. It became effective just in time on February 19, 2020. And this really created a new path for small businesses to be able to elect under Chapter 11, Subchapter 5. And the way you elect is you just check a box in your when you submit your petition for bankruptcy. It really modified many things. We're going to go through a lot of those, but this really was a game changer. Maria, if I could go to the next slide. So what's a small business debtor? It's engaged in commercial or business activities. It excludes single asset real estate cases. So if the only asset you have is a piece of a real property, you cannot elect Subchapter 5. And your debt, and we're going to get, been a change, but the aggregate debt that you had, unsecured debt, cannot exceed, and you love Congress, $2,725,625.15. So you could not be what we call a SAR debtor, single asset real estate case, and you can't exceed the 2.7 plus in debt. So that kind of limited a lot of companies that could actually check the box and say they were electing the small business debtor. But it's been incredible. The next slide, please, Maria. Congress passed the Coronavirus Aid, Relief, and Economic Security Act, the CARES Act, and it passed in March 2020, and it temporarily increased the aggregate debt limit to $7,500,000. Many experts believe that that limit will need to be increased further, perhaps to 10 million. This only applies for cases that were filed after March 27th, and it sunsets next year on March 27th. I'm hopeful that it will be extended because it's needed. Let me give you a sense of what's been happening. In June 2020, there were approximately 200 cases that were filed as Subchapter 5 cases. Through August 16, 2020, there have been 845 Subchapter 5 cases. And through September 13th, we have 1,047 cases. So the cases are exploding. And I think right now we've seen a little bit of a lull, but we're going to see a lot more. Why do I think there's been a little bit of a lull? Because people have been had a lifeline with their PPP loan, and that's helped them. A lot of banks have agreed to forbear action, but those, the banks have shareholders that they have to answer to. So I don't think that's going to last forever. And I think you already see some activity where defaults are being called and companies will have no choice but to file for bankruptcy. Maria, if we could go to the next slide. Okay. Why was Subchapter 5 needed? Because Chapter 11, traditional Chapter 11, did not work. Too costly. Creditors had too much control, and you could not reorganize. When clients come to see me and they hear from friends, oh, just file for bankruptcy, that will solve everything. And if only that were true. But what happens is when you file for Chapter 11, traditional Chapter 11, you lose a lot of control. Brian talked about these opportunities to buy assets. Here in South Florida, we have a lot of closely held family businesses. So can you imagine you have a problem with your lender? You go into traditional Chapter 11 to try to reorganize. Your lender doesn't want to play ball, and you cannot confirm a plan over their objection, and you end up losing your business. I've been involved in so many cases where at the end of the day, a sale of the business was the only thing that made sense. But that meant that a family lost its business. So I'm always thinking, what can I do outside of bankruptcy in order to avoid my client losing control? Subchapter 5 has changed things. Think of the new subchapter as the express lane in bankruptcy. You need to file a plan within 90 days and you have no unsecured creditors committee. Maria, it probably will be helpful after we go through this. Maria's actually had to apply to be a subchapter 5 trustee. And this is just by way of background. Maria asked if she was certifiable. I said, yes, you are, okay? I will answer that question. But Maria, I was on the panel of trustees for 4 years, but I just preferred private practice to handling of volume cases, and it just was not something that I enjoyed. But Maria's been on the panel for a while, but she also had to apply to be a subchapter 5 trustee. And interesting, Maria, I think subchapter 5 works because it was drafted by bankruptcy lawyers who understood what was needed to fix what was the problem with Chapter 11. It's actually one of the best things that we've done, you know, or Congress has done. But I think they listened to the American Bankruptcy Institute, and there was a lot of input from people who had knowledge of how we needed to make this work. And when you applied to be a subchapter 5, Maria had to show experience with Chapter 11, experience with business, and also show that she had, I think, the personality to facilitate that she could help a debtor get across the line. Because I see you more in the subchapter 5 as a facilitator, more than your traditional role as a Chapter 7 panel trustee. And we can talk about that. But let's talk about what was the traditional Chapter 11 and what has changed with the subchapter 5. Oversight. In bankruptcy, we have the United States trustee, part of the Department of Justice, and they oversee cases. We also have, in many cases, an unsecured creditors committee. So the unsecured creditors committee is basically representing the interest of all of the unsecured creditors. They have a very important voice in all the cases, but that adds a layer of expense. That means that the debtor also has to pay for the professionals that are hired by the unsecured creditors committee. And if you're in distress, you don't have a lot of cash going around. I agree with Sergio 100%. Cash is king. Cash is needed. Not a lot of people have liquidity, okay? But you can imagine the stress that it puts on a Chapter 11 debtor if they're paying their own professionals and they also have to pay the unsecured creditors committee. Now, under subchapter 5, the U.S. trustee still has oversight, but you don't pay those fees. And then you pay the fees of the subchapter 5 trustee. Maria, I'm curious, in connection with your application, did you have to reduce your fees, your regular fees, hourly rate, in order to be a subchapter 5 trustee?
I did not, and I think perhaps back to what Brian was mentioning earlier, maybe my fees are too low. I don't know. I do understand that other folks have reduced their fees, but I was able to, I just provided the current hourly rate that I charge to all of our clients. But we are not, just as a clarification, the fees in these cases are paid as part of the plan. So as creditors are receiving their payment, that is how the trustee gets paid in most of these plans. So it will be over, first of all, they're quite modest, and and they do get paid over time as opposed to the debtor having to pay these fees in, 3 months after starting the case.
Okay. No, because I've spoken to many subchapter 5 trustees around the country, and they were required to reduce their fees. I will tell you, Maria, and for everyone in the audience, they did some polling prior to a program of the ABI, American Bankruptcy Institute. And overall, the participation by the subchapter 5 trustee has been viewed as very positive. Like the subchapter 5 trustee has been viewed as the kind of the connection between the creditors and the debtor, has provided assistance in trying to get over the finish line. So it tells me that this subchapter 5 is working as contemplated, and that the debtors believe that this has been the subchapter 5 trustees' involvement has been a positive one. The next is fees. Go ahead.
I was just going to say that we have 6 subchapter 5 trustees in the Southern District, and I think you said earlier that I had to apply, and I think the operative word was had. I think I did not have to do it, but I really felt compelled to apply to serve in that role because I viewed this as the most interesting and productive thing that I've seen in bankruptcy, and I've been doing this for a few decades, and I've been a trustee now for about 9 to 10 years. And this was to me the most exciting thing that I've seen in a long time. So that was my interest in jumping into that pool, and none of us knew what this was going to look like. And at that time, because the applications were back, they were done last year, we could not have contemplated what happened. And also with the limit going up to $7.5 million, it did create, it's a different dynamic right now.
Yeah, completely. I agree with you. Thank you for that insight. So let's talk about fees. I mentioned how Chapter 11 was very expensive for companies. Before, you would pay both the debtor your fees, so the debtor had to pay its professionals and the committee's professionals. In addition, their quarterly fees that are charged by the U.S. trustee program in order to fund that program. With respect to the subchapter 5, now only the debtor's professionals need to be paid from the estate. Also, the subchapter 5 trustee has to get paid, but you don't have the quarterly fees. So that is a real game changer, and I'll tell you why. The limit on the fees, because cases had slowed down and the U.S. trustee fee had been, the U.S. trustees program had been, I think, underfunded. They raised for certain, they raised that fee in certain occasions when the distributions are in the millions to 250,000 in a quarter. So that has become a real problem in many, many cases. What has changed? You had a planned deadline in the traditional case of about 300 days. Now it's 90 days. You really need to have your act together and get a plan. You can't, this is another thing that people think, oh, I'll file Chapter 11 and I'll worry about what I do later. That's the wrong way to go into a Chapter 11. You need to have a plan of what you want to achieve before you go into Chapter 11. Because when a debtor files for Chapter 11, a court will give it the benefit of the doubt for some time. Okay, you're in distress. I'm going to give you some extensions. I'm going to help you, but you have to do your part. But if you have no plan and you're kind of flailing in bankruptcy, the court will see that, and then you'll lose the benefit of goodwill from the court. And you never want to go and use that goodwill until you have to. And if you just kind of, don't do what you're supposed to do, the court's going to lose faith. In a traditional Chapter 11, an unsecured creditors committee could file a plan. In subchapter 5, only the debtor can file a plan. In Chapter 11, you had to file a disclosure statement with your plan. It's what the equivalent of a prospectus, in securities law. Now that is not required. Once again, less fees, less costs. There was a risk of loss of control in the traditional Chapter 11. I gave you the example when you can't bring your lender to a deal, or sometimes lenders don't want a deal, or other creditors don't want a deal, or they've lost faith in you, in the debtor. Here in subchapter 5, it's very, very rare that you lose control or the debtor loses control. Debt limit, we've already spoken about in Chapter 11. You did not have a debt limit. Here, 7.5 for now, or at least until March 2021. Administrative expenses. In order to confirm a plan of reorganization, you have to pay all administrative expenses on the effective date of the plan. Administrative expenses are the fees and costs of the professionals. And that many times was very hard unless the professionals agreed to different treatment. Now you can stretch those fees and expenses over time. Unsecured creditors input. You got it through the committee. Here, now you deal with the creditors individually. I talked about the involvement with the subchapter 5 trustee. Sometimes a creditor has lost faith in a debtor, and really no matter how valid the input of the debtor is, they're the wrong messenger. To the extent that a subchapter 5 trustee can deliver that message, I think it carries a lot more weight with the creditor body. Preferences, I don't know if any of you have ever met a friend or a client who receives a letter that they received a payment from a debtor within 90 days and they have to give that money back. I can't tell you how many people I know that think it's the most unfair aspect of bankruptcy. And the bankruptcy code is just trying to bring in money that went out the door within the 90 days before the bankruptcy, likely because of creditor pressure, and put everybody on similar footing. Before, I don't think you were required to do much due diligence. Now you have to do reasonable due diligence, and there's certain thresholds that have been changed from 13,000 a change to 25,000. So you can see, I think the input by the bankruptcy professionals really resulted in a very debtor-friendly result that has worked. And I think the proof is in the pudding. I mean, you see the number of filings and the number of opinions that have come out regarding subchapter 5 is staggering. So I think the judges are still figuring this out. But in my opinion, many of the opinions have been debtor friendly. So I think that tells you that we're now in a new wave of bankruptcies where many courts find that debtors ended up in Chapter 11, especially subchapter 5, through no fault of their own. And they're going to give them that lifeline to be able to emerge from subchapter 5. So Chapter 11 versus Chapter 7, I think Dan said that there was a couple of questions. So let me see if I can get the questions. Okay. So the positive side of the pandemic, I think is that for the pen? Oh, I see. Sorry. Now you have to answer a question. I'm sorry. It's one of your polling questions.
Yeah, Corey, the questions that came up on the Q&A, one of them asked, can the court dismiss if filed in bad faith?
The court has the right to dismiss, but I will tell you this: the law on bad faith before the SBRA was filed has been fully developed. I think it's extremely difficult. For example, I'll give you the classic case in South Florida. The classic case in South Florida is a debtor, a corporation has been fighting a foreclosure. And trying to delay. And the day before the foreclosure sale, or the day before the final hearing, the debtor files for bankruptcy. And before, we had a very famous case, which you could cite to, that said, this case should be dismissed because it was filed in bad faith. It was only to delay the sale, and there's no prospect for a reorganization. What has happened in real life and in the courts is, okay, we know the timing, we recognize the context, but what we're going to do is we're going to give the debtor perhaps a shorter deadline to file a plan, in the traditional Chapter 11. But right now, I do not see courts being very open to dismissing a case based on bad faith. They're going to give these debtors time to reorganize. It may happen sooner rather than later. Do they have the right? Does the court have the inherent right? Yes, but it's very difficult to get the case dismissed on day one.
Corey, another one of the questions is, and I think the timing is good to take it at this point, is can the plan deadline be extended? And I'm assuming they're asking in the subchapter 5 context.
Yes, it can be extended for cause, but it has to be for cause for circumstances that the debtor could not have anticipated. So it's a yes, but you have to come in there with a real reason. The case law, I've seen some cases on that. I think the debtors are going to be able to articulate a reason for why cause should be found to extend. Maria, have you seen that in any of your cases?
I have not seen requests for extensions, and I think that the court, as you were referring to earlier about that good faith, if they're seeing that and that goodwill with the court is that you are moving things along, you're having your hearings, you're prepared, you've been having conversations with the creditors, I think that's all viewed positively. And so judges are very wise and attuned to what's happening in their cases. So there are also hearings very close together in a subchapter 5. That was a very big change, I think. So the court is hearing from the attorneys every few weeks. This isn't months now, but every few weeks. So I've seen a significant amount of understanding about the debtor by the court, just because of the amount of involvement in a short time frame. And so they're aware of the efforts, I think, that the debtors are making.
Yeah.
Sure. I'm sorry. Another interesting question is how do personal guarantees on business debt, we were talking earlier about these family businesses, which I know is why you're grinning, family businesses, how does the personal guarantees on business debt impact your ability to file a sub-5 case?
So if I understand the question correctly, and it's interesting, can a guarantor file a if the question is, can a guarantor of commercial debt file a subchapter 5, there has been already case law on that, which is, and the courts have said, not many courts have looked at this issue, but the courts have said yes, because they find that this is related to being involved in a commercial activity. So the courts have answered that question, that a guarantor can file a subchapter 5 and comply with the definition of a small business debtor. The U.S. Trustee's Office, I don't think, agrees with that and does not believe that that's the right reading of the code. And if this question relates to what happens to the debt or the guarantor if the company files, there's two things. One, they can pursue the guarantor outside of bankruptcy unless the debtor is able to obtain what's called an Otero Mills injunction. And that's named after a famous case. And you'd have to show that the guarantor being involved in litigation regarding the guarantee would be so disruptive that it would take away that person's ability to reorganize the debtor, and therefore an injunction should be issued barring the creditor, the bank, from pursuing the guarantor while the Chapter 11 case is ongoing. So I've answered it from two different perspectives. I'm interested to see if clients ask me about a notarial mills injunction and the probability of obtaining that in a Chapter 11 case, I would tell them it was a very low probability. I'd be very interested to know whether this is going to change in the current place that we find ourselves. Will courts view this differently? You know, Sergio went through all the challenges that business owners are facing. And really, it's quite challenging. So if you add one more drop, you know, to what already is a very full cup, will the courts look at this issue a little differently? I could find myself making a much more compelling argument in bankruptcy court as to why an injunction is needed, so I have the full participation and attention of my principal in order to emerge from Chapter 11.
I think the other issue that is considered is how involved is that principal in the business? Is it an investor, or, you know, a principal that basically is not involved in the business but just funded a company? And when you look at the small businesses that we have in our community and family-owned businesses, those individuals are what I call part of the working group, and they do have an impact and need to be focused on the business. So I think that's something a little bit different than some larger enterprises. There is another question. Does individual creditor input process add significant time to resolution over creditor committee input?
I think creditor input adds to, can you repeat the question? Let me just read the question. Maria, can you read the question again?
Does individual creditor input process add significant time to resolution?
I think that you're going to have, many times creditors are not very involved. That's why you have a creditors committee in the Chapter 11 case, because a lot of individual creditors don't want to hire a lawyer and have that expense when they've already seen that they're going to have a bad debt on their books. So most creditors in a Chapter 11 will not have lawyers. You know, obviously there's exceptions on how big the case is, okay? But with respect to individual creditor, you know, process that you have in the subchapter 5, it depends. It depends whether creditors want to row the boat in the same direction as the debtor. If you have a creditor who, for example, really doesn't want this debtor to survive because strategic reasons, there's no amount of dialogue that Maria can have with that person that will change his or her mind, because they have a strategic reason for why they don't want this particular debtor to survive. So I think the creditors committee can be very helpful if you're both on the same page, because the courts will really listen to the committee. But I think probably in the subchapter 5, you have some very active creditors. Maria will have to interface with those creditors, but not every creditor in a Chapter 11 or in a subchapter 5 will be involved in that process. You have another polling question. So let me, I want to get through this because I do want Brian to get through his last section. Just real quick, because I think this is always a question that comes up with companies, and these are questions that this audience may have. Chapter 11 versus Chapter 7. In Chapter 11, you try to reorganize and you have that opportunity. We now have this subchapter 5, which is the Chapter 11 in the express lane. They have to prepare a plan which lays out how creditors will be paid over time. That's really the end game. I want to go back to what Sergio started with, which is in that business continuity in 2020. He talked about risk and uncertainty. liquidity, supply and demand shock. So think about it. How do you propose a budget? How do you propose a forecast if you don't know whether Miami-Dade is going to shut down your business or whether the state of Florida is going to shut down your business? You don't know what's going to happen with your supply chain. And the risk and uncertainty regarding this pandemic is so big. So I view in traditional Chapter 11 and Subchapter 5, showing the court, proving to the court that your plan is feasible is a very hard challenge right now because of the risk and uncertainty, because of the liquidity issues, and because of supply and demand and the risk of having your company shut down. The next slide. Chapter 7 liquidation. I will give you this free legal advice. I rarely put a company into a Chapter 7. I just don't. I think there's too many. I think you have a lot of litigation in Chapter 7. It can be very litigious. And if it, to the extent that I can avoid Chapter 7, and we're going to talk about alternatives, I rarely put a corporation into a Chapter 7. I may be pleasantly surprised during this pandemic that it works the way it should be, but I rarely do that. Maria, as you know, she is a Chapter 7 panel trustee. I was that person too. But Chapter 7 panel trustees come in all shapes and sizes, and you do not know who's going to be appointed to your case. Some trustees are more reasonable than others, and it's very difficult to predict that. What happens is the Chapter 7 trustee sells all of the assets, and creditors are paid from those funds after the Chapter 7 trustee receives his or her fee, and her professionals are paid. So that's really, you throw it into Chapter 7, and the owners are no longer involved, and the trustee takes over. So it's a complete liquidation, and it's gone. Collateral benefit, and I think that I've mentioned this, and I think also, because it's not all bad news, the banks have been better. Don't know for how long, but the banks have been better. There's no doubt about it. They have been, they have a lot of loans to deal with. They understand this is unprecedented, but I represent more borrowers now. I used to represent a lot of banks, but I'm really more on the debtor side right now. I do represent some banks in all of their bankruptcies, but the banks are more reasonable. Landlords, I love using this phrase, how the turntables have turned from The Office. So before, in bankruptcy, the landlords had all the leverage. Everything. The landlord lobbyists have done a magnificent job in including all these little presents in the bankruptcy code. But now the tenants have all the leverage. They're literally just going into bankruptcy, asking the courts to defer payment on the first 60 days, which usually you had your pay to play. You had to absolutely, pay in order to stay in your space. Now they're getting a 60-day, almost as a matter of course. They don't have to pay their landlords during the first 60 days. So you can imagine, with respect to big cases like JCPenney, Neiman Marcus, and all the other retailers, this is a true lifeline, and they're saving a lot of their cash. Eventually they're going to have to pay that rent, but they're saving a lot of cash. In addition, the PPP loan has been a huge help to many small businesses, and I see that has literally kept them in business, for the past few months. I think what we're going to see is just a tsunami of bankruptcy cases once that PPP loan, runs out, which it is, and also when the forbearance by the banks expires and they start litigating with their borrowers. Next slide. Alternatives. You have a polling question. Real quick, I talked about alternatives to bankruptcy in order not to lose control. Why explore? You don't have a trustee appointed to your case in a Chapter 7. You keep somewhat control of a company, and you have a lot less litigation. Sometimes you have a chief restructuring officer. Maria has been commenting to us on the panel as we've been getting ready that she's serving as a CRO with a technology company, and that has kept her very busy. So she's gone in there and started to run that company. And sometimes you need a CRO because I'm dealing with a firm now that I'm advising. And Maria looks at the balance sheet, she looks at the P&L, and she looks at it objectively. Your owners will look at, when you have the payroll costs, they will see the people. And it's so hard for them to make difficult decisions. But you have to make the difficult decisions in order to survive this pandemic and get to the other side of this. Sergio spoke about payroll. Did people make cuts in the payroll that are just now going to be permanent? They realize that they can operate with a much lower payroll. But I think people like Maria look at this. Maria's a very good person, but if she wants to get her company to the other side, she has to help them make very tough decisions. And that's sometimes a way to fix the operational deficiencies. And sometimes there's a lot of trust issues with the lender. So I talked about messaging. Maria can talk to the lender because maybe the lender no longer trusts or has faith in their borrower. And then finally, an assignment for the benefit of creditors. It's a state court liquidation. The debtor literally signs a very simple assignment and transfers all legal title, custody, and control of its property to a third party. The good thing is, if I want my debtor to do this, I can at least pick my assignee. I can pick my trustee. I can pick someone who will act as a fiduciary, but I know that it's a reasonable person. The assignee will sell all of the assets and then distribute to creditors. Very similar to a Chapter 7 liquidation, but it saves a lot of time and expense, and it takes place outside of bankruptcy. It takes place in the state courts. Here in Miami, we are now in a much better position because the judges are more familiar with what we call the ABCs, and they have been able to, I think, manage that caseload better. And I know from talking to the judges, they are expecting an explosion of ABCs. But that is actually a pretty good alternative if the debtor determines it cannot reorganize, it cannot do anything but liquidate, but it wants to liquidate in an orderly fashion. Thank you.
Thank you, Corey. And Brian, we all love taxes, right? So this is a great segment to finish off the morning with. If you could talk to us a little bit about, at the end of the day, what we do on the books as accountants is one thing as far as projections, and but when it comes to taxes, I'm not sure that it always lines up. We're getting benefits from PPP loans and other things that are helping these businesses. But I think it'd be good to understand from a tax perspective, how is Uncle Sam looking at this?
Okay, perfect. Thank you. Yeah, and I probably could talk about these rules for 2 hours, but I think on a Friday at 8 to 10, it'd probably put everyone back to sleep. So I will attempt to cover them as fast as possible. And I promise I will try not to quote any code sections here. So at a very high level, why should anyone care about taxes when they're considering to do a debt workout? And the reason why you should care is if you're going to wipe out any level of debt without any special rules in place, that could be taxable. And if that were taxed, that would be, significantly affect a company's ability to do business after the debt workout, right? If they had a 20% tax bill on settling a debt, that could be catastrophic. So the rules are put in place to help that. You'll see here exclusions from taxable income to the extent that a company is in Chapter 11 or a company is insolvent. Typically, the company, if it's a corporation, is going to be allowed to exclude that cancellation of debt income from taxable income. One small caveat here, if it's a partnership, that exclusion is actually measured at the partner level, that can be pretty surprising sometimes to those partners, because they may not be in the actual bankruptcy filing and may get hit with a tax bill they weren't expecting. Now, the exclusion from taxable income, though, is not a free lunch. What happens is, if you exclude taxable income, you have to reduce your tax attributes. So those could be things like net operating losses. Those could be things like your basis in property. And the effect that it has is that it effectively is going to create more taxable income in the future. So it's sort of a delay on the taxability that the company is going to pay over time as they, get healthier, move beyond the settlement. In addition to that, to the extent that there's an ownership change, so if the lenders take over, someone else takes over, there's another set of rules that limits the ability to use some of those attributes. So things like the NOLs, if any NOLs survive, they may be impacted as well. Long and short of it, these rules are extremely complicated, quite frankly, and they rely extremely heavily on the company's specific facts. I've seen before companies have very similar fact patterns, but maybe slight variations, get extremely different answers on how these rules work. So, Corey, I love what you said about having a plan. I think this is another just, emphasizing why it's necessary to have a plan and to think through the tax issues. I like to think of the rules and the facts almost like a kaleidoscope, right? That as you twist them slightly, you're going to get a different picture. So if you're able to plan, you're able to potentially change some of your facts and get a potentially, frankly, a better answer. You might be able to limit not only the types of attributes that are reduced, you may have the ability to have the less attribute reduction, which is sort of the free dessert, let's call it, where you have cancellation of debt income and you're not wiping out an attribute. So going forward, you're great. The other thing I want to touch on is just going back quickly to that last slide here is when do these rules apply? Obviously, they apply anytime you're settling debt, whether it's in a Chapter 11 or out of court, Chapter 7, these rules could apply. One very surprising thing, though, is these rules can apply even if you're modifying the terms of your debt. So some companies may work with their lenders to push out that principal payment, to change the interest rate, to do a lot of things rather than going through something more drastic. It consistently surprises companies that this could raise these tax issues, right? I owe $100 today and I owe it tomorrow. Why would I have cancellation of debt income? And unfortunately, that is the way the rules are written. And so it's important that if you're modifying the terms of your debt, even changing covenants, technically the rules say that those that wouldn't lead to a cancellation of debt income, but technically you're making, a lot of the times you're going to make a payment to the lender, so it actually can raise the rules. But no matter what you're doing, if you're changing the terms of your debt, it is important to understand, hey, am I going to have a huge tax impact to that? So going on to the next slide, there's obviously other tax considerations as well. I was more focusing on the income tax side on the last slide, but sales and use tax, if you're structuring the debt workout as an actual sale, sales and use tax issues can be raised. There's a ton of payroll considerations. How do you report all of this for tax purposes can be huge as well. If you're setting up another company, do you have to do new registrations and other reporting? And then liquidating trusts. We didn't talk a lot about liquidating trusts, but obviously they're a vehicle within the bankruptcy process that could be used to administer the distribution of assets. They have their own sort of set of income tax and tax issues as well. That's important to consider. So I think I fulfilled my promise. I don't believe I quoted one tax section. So thank you for that. And then turn it back over to you, Maria.
Thanks, Brian. I think it's generally the bankruptcy people that are always quoting and speaking in numbers by the bankruptcy code section. So I think we're just as bad. There were, in the CARES Act, there was also there was an impact on NOLs, and the net operating losses, and being able to carry those back.
Yeah.
And so that's something that we started to look at in the regular Chapter in 7 cases and 11s to see if there was something we could recapture there. So for instance, if you had paid taxes in the prior years, you had an opportunity to go back and apply NOLs and seek a refund for those for the monies you previously paid. So on the bankruptcy side, it's another source, right, of funds. There was a question, Brian. I work with a large commercial real estate finance, and forgiveness of debt tax implication is a major consideration. How can we help owners evaluate their options?
Yeah, you know, I think the key is to get ahead of it. So as quickly as possible, to the extent that you know something is going to be happening, start having those discussions, and then start modeling out, or at least, you know, thinking through what those issues can be. So, you know, often, you know, we sort of have a mantra about the earlier the better. The earlier you can have these discussions and understand that they're going to do something, the better, because you can get ahead of it. You know, there are ways at times that you can potentially structure around the issues. This doesn't necessarily happen as much if you're going to sort of forgive the debt. You're going to, you know, have to run through how everything works out. But especially in the debt modification, there are some things that you can do that you can work with the lenders potentially not to trigger some of these. So earlier is the better.
Thank you. Do the participants have another polling question there?
I think we're all hoping for all of the above, right, on this one?
Good question there.
I don't know. I voted for you guys. Okay, so we're getting close to wrap-up time. I wanted to leave you with this is our contact information. It's part of the slide deck. And so hopefully, I felt a lot of pressure at the beginning of this presentation with Miguel's reference to donations and being able to donate funds after the presentation. I thought the pressure is really on to do as good a job as we could, and hopefully, you know, a little more this morning about what companies are thinking about, and you're more aware of tax implications as Brian discussed with all of us, and also some different thoughts that Corey described on the bankruptcy front. And bankruptcy is not always the answer. There's options outside of the bankruptcy process, but I think we've also talked about some of the really positive things that I'm seeing with the subchapter 5 cases, and this is it's all brand new. It's brand new to us as trustees, brand new to the judges, brand new to the attorneys filing the cases. So if we're having this conference next year, it'll be interesting to look back at this morning and see how things have changed. So let me. Okay, I think we are done with questions. I thank everybody for their time and attention. And these things are always rough. Fridays, 8 o'clock in the morning. So thank you for joining us, and we look forward to it. Please feel free. You have our contact information. If there are questions that you have for any of us directly, please also do that. And I thank all the panelists. They've worked hard to put together this presentation for you this morning. And I wish everybody stay healthy, wear your mask, and have a great weekend.
Thank you, Maria. Thank you, panelists. Take care, everybody.
You as well, Dan.